What I am going to get into talking to you about right now is how we cannot fully prevent audits, but we can understand the signs and things that could trigger them. That's number one. Also, I want you to know that audits are not common here in the United States, even though it's something that is talked about a lot. It's not like it happens to everybody or all the time, okay? For example, between 2010 and 2018, only 0.6% of tax returns were reviewed or audited, okay? That's a very small percentage, but it's enough for people to be worried, concerned, and actually get to know some of these details. Now, we're going to get started with number one, and that's your income, okay? So your W-2 or your 1099 income. Basically, the way this works is when you have forms that report income that you've earned, whether it's through an employer or as an independent contractor or anything else, right? Anything that you may get a form for is going to also be sent to the IRS. So not only did you receive a copy, but the IRS received a copy as well. And if you were to file your tax return and exclude that or have some type of discrepancy, it basically triggers an audit or a red flag. The IRS does something called document matching. So when their computerized system realizes that something's off, that shouldn't be off, it just triggers them to research into it more and to ask you for proof and evidence on what you've sent to them. So now it's the ball's in your court to provide supporting documents. If you do not provide those supporting documents, then they're going to make a determination based on the information that they have, and it's not going to be in your favor. So I do recommend that, even though it's like heart-wrenching when we receive those letters from them in the mail, and even though it makes you sweat and anxious and scared, you still have to open it and you still have to respond to it. If you're too afraid to respond to it, get someone who does it all the time, like myself. All right. That's number one. If you have a question with number one, please put it in the comments and I will do my best to answer it. But for now, I'm going to move on to number two, which is underreporting business income. Okay, so actually number two and number three kind of go hand in hand. So if I start talking about number three, then just let me know. And number three is, I'll just show you real quick, over-reporting expenses. And this is regarding business expenses. So back to number two, okay. The IRS does something like they compare your tax return to the hundreds of millions of tax returns that have been filed to them in the year, and also over the course of other years. So they're just very resourceful. They are able to get information, compile information, and use it to see if you're doing what you should be doing or not. Okay. So one of the things that they do is they look at your situation and they compare it to people who are like you or people who are just similar to the shoes that you're in. And if your situation is way off than the norm, that's what triggers an audit. So if you have a Schedule C, which is for self-employed individuals, it's a Schedule C on your 1040 tax return, and you went too low on your income based on what they are looking at as a standard, right, or average, they may actually ask you for documentation or for proof that this is the correct dollar amount that you put on your tax return. Now, I don't want you to feel like all of a sudden everyone's thinking that you're lying, okay? It's just asking you to support your numbers. Okay, and that's how you have to enter into a process like this. You have to enter into it willing to support the numbers that you put on your tax return. So the next thing would be your business expenses. So they look at your business expenses and they compare it to your business income. They look at it and compare it to other individuals that are similar to you. And they also compare it to other tax returns that you have also filed. One of the things that they're looking for is to see if you, by any chance, actually have a hobby and you're trying to mask it off as a business. So if you're doing something like that, then basically what happens is that they will disallow your expenses. Okay. And now you have to pay tax on the income without any expenses, which is extremely expensive and not fun at all. Okay. So you don't want that type of situation. So what you want to do is just make sure that your bookkeeping is straight. But once we get to the end of these red flags, I'll talk about the strategies and the things that you can do to protect yourself, and just make sure that you're prepared. Okay. We're going to go on to number 4, which is the earned income credit peak. So basically, what this means is, let me just make sure I'm at number 4. Yes, I am. Okay. So basically, what this is related to is for people who are self employed and they actually report an income amount that puts them in the sweet spot of the Schedule C. I'm sorry, of earned income credit. And I'm actually just going to share a slide real quick so you can see. Here we go. Okay. And let me just move this out your way. Okay, so it's hitting the sweet spot for the earned income credit while filing a Schedule C tax return. What this is saying is that there is a point with the earned income credit where when you're at the top of the peak, right, it's the highest amount. So the earned income credit is a large credit. It's a big credit that a lot of people get. And because of that, it has been abused a lot. And due to this abuse, the IRS has gotten hip to some of the strategies and tricks and things that people do in order to maximize this credit illegally. Okay, so there are people who get the max and they're supposed to have that. But what they're looking at are people who are getting the max and they are not supposed to have it. So they are pretty keen on the tricks and tips that people do in order to get to that point. And that triggers an audit because now they want you to prove that you were supposed to have the max on this credit. Now, one of the things that people will do is put their Schedule C income right where it needs to be in order to hit that mark. And when this happens, the IRS pretty much start looking at the history of your tax returns and other things of that sort, and then they decide whether or not they want to review your account or audit you. Okay, so let me just get rid of this screen and go on to the next one, which is high itemized deductions. Okay, so your itemized deductions are things like your medical expenses and charitable contributions and your real estate taxes and your mortgage interest and several other things. Okay. So what happens here is like the higher your itemized deductions are, the lower your tax. And a lot of times people will bump those numbers up more than what they should be because they definitely want tax advantages or to save money and not pay as much tax as they're liable to pay. So when this happens, the IRS is basically looking for people in those type of situations because they believe that they are basically committing fraud, but it's more so like, okay, well, you were not entitled to this deduction. Let's change it and charge you the tax, interest, and penalties on this. Okay. But what they're doing in order to catch people are, again, they're comparing your profile to someone else's profile, or again, hundreds of millions of people. Okay. They're comparing you to tax filers in America to see where do you fall. Okay, the next one is high donations. So this is in regards to charitable contributions. It's kind of similar to the previous one, which was on itemized deductions. The thing about charitable contributions is that, first of all, there is a max when you have earned income. You can't donate over a certain dollar amount and receive the credit for it. That's number one. Okay. But the second thing is they are looking at um, your income versus the dollar amount that you've donated, and they're trying to make sure this makes sense. All right. So if you made $100,000 for the year and you donated 95,000, they're basically going to think that that makes no sense. How did you even pull that off? Of course, people have, things that are valuable, or they have money saved away, or money under the mattress, wherever people put it. But it still triggers, um, it still causes a red flag and could trigger an audit. I just want to make a note real quick and say that these things that I'm telling you is not a definite, okay, that you would get audited. I'm not saying you would definitely get audited if something like this were on your tax return. I'm saying that situations like this may cause your account to be reviewed or audited, and being aware of them can help you prevent that. Although we cannot fully stop the IRS from auditing anybody, you can help yourself by not falling into these areas where they're targeted problem areas. So the next one is number 7. And that's funny because I had high donations as number 4. But yeah, let's see. This is number 7. I think, let me see here. 8, 9, 10. Yes. Okay. So I'm at number 7, which is not reporting cryptocurrency. So it is no secret that the tax law is behind. It takes a while for the tax law to catch up to what's happening with technology. Okay. Because they have to first understand it, then they have to see how it affects people and how it affects, the country as a whole, and then they have to figure out what they can legally do to resolve any types of issues or loopholes that there are. And this can take several years because they're looking at data and information to draw these conclusions. So the tax law can be far behind, maybe 5 years behind what's happening with technology. um, there was a point in time, and it may still be happening, where people are not reporting their cryptocurrency. There was a belief for a long period of time that cryptocurrency was not taxable. Okay, but it is true that, let me rephrase this, cryptocurrency is taxable. Okay, when you are creating a taxable event. So if you're trading with your cryptocurrency, or if you're using it to purchase things, or if you're cashing out, then you're creating a taxable event and you have to report that. If you simply just purchased cryptocurrency, then you did not create a taxable event. Okay. Now, what this one is about is people who have created taxable events. However, they have not reported this income on their tax return. What's happening now is that these financial institutions, or these platforms where you're using the software in order to purchase your cryptocurrency, they're going to start reporting these transactions to the federal agencies that are requiring this information, so people won't be able to have the same type of benefit of not reporting this and not being known. Okay, like being under the radar is no longer going to be a thing. Okay, so um, for those who are not reporting cryptocurrency, you will be sending a return off with a red flag on it. Okay. The next one, and this is number 8, is claiming two people claiming the same dependent. So let's imagine that um, you and the parent of your child are not together. You live in separate households, but you equally share time with the child. You equally take care of the child, and you feel like you both have the right to claim the child. Okay. This can even happen when you're living in the same household. Okay. You can live in the same household and still have an issue or a discrepancy or an argument over who's claiming the child. So there are many instances where people are actually putting a child on their return, even though it's already on the other parent's return. And it could even happen with individuals who are, say, let's just say the child's grandparent and the child's parent are bickering over this, or maybe they're unaware of it. But a dependent being on two tax returns causes a red flag. Okay. And that will cause the IRS to basically reach out to figure out what's going on and how they're going to resolve the problem. Okay, give me one moment. I see that there's a comment here. Let's just see if it's a question. To basically reach Sorry. Out to figure. I gotta turn my volume off. The problem. There we go. Now I can look at the comment. Oh, it's Jabrina. Hey, Jabrina. What's going on? Thanks for being here. Hey, Taban. I see you here. Okay, so discrepancies over dependents, whether it's a child or any other type of dependent. If two people are claiming the same dependent, just know you're going to get a letter in the mail, because now they need to sort that problem out. Only one person would be eligible for it. So this is definitely something that's going to show up. The next thing is the wrong filing status. So what this means basically is if you were to claim a filing status that you were not entitled to claim, or you weren't supposed to claim that status. So I'll give you an example. When people are married and they file separately, okay, it could trigger an audit if one spouse is filing separately and the other spouse is filing single or head of household. Okay, again, I'm not saying that this is definitely going to pull an audit, but it's one of the things that the IRS can look at and say, you know what, let's look into this and see, why did this spouse file single when the other one filed married, filing separately? How would they know about this? Well, when you file a married filing separately tax return, your spouse's information, their name and their social security number is listed on there. Look at the 1040 at the top of a 1040, and you'll see that. You'll see a checkoff box, and then you'll see spouse's name, spouse's social for that status. And that's how the IRS knows about it. All right, the next one is failure to report overseas bank accounts. So this is basically regarding, and let me see if I have a slide for this here. I actually do. Let's see, where is it? Actually, the slide says exactly what I just read off. Failure to report overseas bank accounts. So this is something that can also trigger an audit or a review of your account, because now financial institutions are starting to report your financial information, basically what's required of them to report to the federal agencies. All right. So if you are neglecting your responsibility and your obligation to complete the correct forms and file them on time, then it could trigger, again, a problem, a review of your account, or an audit. So make sure that if you do have a bank account that's overseas, that you know the rules and you're following the rules, because the penalties for this type of thing is very harsh. Okay. Let's go to, I actually missed one. And so I'm going to go over to my notes so I can show it to you guys. It's right here. Okay, so this one here, let's see, is saying that, okay, I see there's a question from Jabrina. I'll get right to you in just 1 second. This one here is saying that, 1 second, that categorizing expenses incorrectly for real estate rental property can trigger also an IRS review or audit. So basically what this is about is like when you have rental real estate property and you have certain types of expenses or things that you paid for, depending on what it is, it has to be categorized a certain way. So some things are categorized as expenses that should be deducted, like you could deduct the whole amount off of the tax return in that particular tax year. And The other categorization of it is where it's capitalized and it's basically depreciated over a period of time. So a lot of times people are unaware of these rules and they may take something and say, oh, you know what? I just installed a driveway and it cost me $10,000. I want this as a full write off. But something like that may actually, it should actually be capitalized and then deducted over a period of time. So again, the IRS is just very resourceful. They're comparing returns, that are filed to other returns that are filed, and they're looking to see if things make sense. And so they may not catch everything, of course, because like I said in the beginning, it's not like this is definitely going to trigger an audit. And only 0.6% of tax returns over that period of time that I gave had been reviewed or audited. But at the same time, you just need to be aware of it. And if you are doing something incorrectly, please fix it and just make it right. Okay, so let me just see here if I can pull up a comment. Okay, Jabrina said, for clarity, a bank account in a foreign country is reporting back to the USA. Yes, that is correct. Now, of course, it would depend on what bank in what country, but the federal government is starting to basically create more and more relationships as time go on and have these banks agree to submit this information to the United States. And this is for US citizens, okay? So if a US citizen has an account in a foreign country, or if they have signing privileges over an account in a foreign country, then that financial institution or bank may actually be reporting that information back to the federal government. And then what would end up happening is that if a person has a requirement to report that information and they didn't, then they are deeply penalized. It just causes a lot of problems. So it's good to be aware of the rules and requirements for that type of thing. Okay, so then let's see here. I'm going to move on to the next part, which is letting you know how to prevent these type of situations. And I know that I pretty much touched on it a lot, but I'll go over the step-by-step process. Sorry, I'm thirsty. Okay. So the first thing is to keep all of your receipts in your records. And I actually have a record keeping class that gives you full on details and even a workbook on how to do that. It's one of my 5 for $5 deals. So I'll share that information with you guys if you're looking for it. But basically, you just want to keep all your receipts. Now, a lot of times, people think that because it's on their bank statement, it qualifies as a receipt. And sometimes that works, sometimes it does not. Because if you went to Walmart and purchased office supplies one day and then went to Walmart another day and purchased groceries for your household, your your bank statement is not going to say that on this day you purchased office supplies and on this day you purchased, household goods and groceries. All right, your actual receipt from the store would say that. So you need to keep your actual receipts in your records. I wouldn't care if you put it in a shoebox, if you put it in an accordion file, if you scan it into the computer, if you're using a software for it. I don't care how you're doing it, as long as you're doing it. Okay, if you don't know how to manage the records, that's fine. As long as you keep them and you allow somebody to manage them for you. Okay, so don't get rid of it because you don't know what to do with it. Just make sure you're putting it in a shoebox and put it on the bottom of your closet or something. Okay, so let's go to the next one, which is keep proper bookkeeping for your business. Your bookkeeping can prove that you filed your return correctly. So this is for people, obviously, who are business owners. You want to make sure that you have a professional doing your bookkeeping. Okay. I know when you're looking at these software programs and you're looking to purchase something, a lot of people say, oh, it's easy to use. I can't tell you like how much time it takes to to fix a client's mistake and then do it right, than for me to just do it right from the start. Because to fix a mistake, you have to find out where things went wrong. You guys would spend so much money, like waste so much money for someone to correct your bookkeeping than you just paying them from the start. Bookkeeping is very affordable for small businesses. I think that you should have a professional do it, or you should take classes, professional classes, not YouTube. Okay. You should take professional classes to learn how to do it. Maybe become a certified bookkeeper or something like that. Next is only the dependents that you know that you're entitled to claim should be claimed on your tax return. Okay. In other words, if you know you're not supposed to claim a dependent, please don't do it because it just leads to problems later. The parent or the person who has the right to claim the dependent may actually end up doing that. I can't tell you how many problems happened when COVID's stimulus payments took place, and so many people were not receiving their stimulus payments because it was going to somebody that claimed their child the previous year. And then that individual wouldn't give the payment over to the parent. There's just been so many issues. So, and my advice is if you are not supposed to be claiming the dependent, please do not do it. It's not worth it. Okay. Just follow the rules and file your return the correct way. The next one is to get all records from income producing activity, no matter how subtle. So basically, what this is related to is if you have multiple jobs, let's just say you worked 5 jobs during the year, make sure you have all 5 W-2s. Okay. If you are self employed and your clients pay you with checks, but none of them gave you a 1099, just save all the check payments that your clients are giving you. Now, the reason why this is important for self-employed individuals is because if you are putting your own money into the business, then that is separate from money that you're receiving from clients. And money that you put into the business is actually a contribution. Okay. You're putting capital into your business to keep it going. So it's not taxable income. However, if you are receiving a payment from a client and you put that into the business, that is taxable income. So there's a difference here. But now I want you to know that um, any income producing documents that you have, please save it, okay, and keep those records. Now, one tip, real quick, is if you did have 5 jobs or however many jobs, right? Let's just say that you're only working at one of them, but you had several throughout the year. Once you're done working for a company, you can ask them for your W 2. You do not have to wait until January to receive it necessarily. Now, different states may have different laws and they may give employers flexibility to determine like how they would react to this rule. But you can technically ask your employer to send you your W 2 maybe 30 to 60 days after your employment has terminated with them. Okay. So I would recommend that first of all, make a note of who you worked for, keep track of their phone number and their address so that way you can look back on that record at the end of the year and make sure that you just have all of your W-2s. I also recommend that you ask them for it once your employment is over, regardless of if it's the end of the year or not. That's it.